Robbie, you logged in? All right. It's going to be delayed like 20 or 30 seconds. Hello, my name is Tom Vassallo with MRW Financial Brokerage, and thank you for taking the time to participate in this webinar about our long-term care planning toolkit. This was developed for several purposes. One, I think it really benefits Medicare advisors as well as financial advisors and money managers and other people wanting to make an impact in long-term care. Part of the concept of the toolkit is our long-term care planning guide that for Medicare advisors during AEP, when you're really busy going from house to house, for clients that have assets to protect, you can leave behind this long-term care planning guide. It has 18 different integrated videos in it to help establish the need for long-term care and then let them know you'll reach out to them in January or February. We're also going to talk about the Pension Protection Act and how you can access non-qualified annuities income tax-free. First, a little bit about myself. MRW Financial Brokerage, we're a brokerage general agency based in Tampa, Florida. I've been personally specializing in long-term care for 32 years now. Started off with the traditional long-term care, then moved on to the asset-based long-term care, which is taking over the market today and really solved a lot of the problems when it comes to long-term care. I still believe long-term care is one of the most undersold products in this country, and for good reason. The old traditional products were not very good products. Terrible history of rate increases, use it or lose it for long-term care. The new products solve all of those problems. So let's talk about the market opportunity and demand for long-term care. First, of course, we have an aging population. By 2030, all of the baby boomers will be over the age of 65. We also have it's an underserved niche. There's not a lot of people that really specialize in long-term care, and that's another reason we developed this long-term care planning toolkit. It's to help get advisors up to speed, but also give you the tools to communicate exactly how these products work and how they work effectively. And of course, there's growing client awareness. One of the things I look when I go back to the personal clients I've sold, I bet 70% of them that have purchased long-term care plans did so because they became aware of the problem with a family member, whether it was a parent, a sibling, an uncle, or aunt. They saw that Medicare is not there, that Medicaid is not there, and they're having to spend down their own assets for long-term care. And they realize they don't want to put their kids in that situation. Make no mistake about it. Medicaid is a program for individuals that don't have any assets. It's a safety net. If you don't have assets to protect, there's not a need for a long-term care plan. Long-term care is about asset protection and protecting your children in the long run. I don't know how many of you are familiar with the Washington Long-Term Care Trust Act, but here's what it did. In the year 2020, sales in Washington represented 3% of national long-term care sales. In 2021, when this act was passed, 60% of the sales nationally for long-term care came out of the state of Washington. And here's what it did. It basically, for all Washington residents, gave them a 1 year long-term care benefit that would pay $3,000 a month. Now, of course, the state of Washington had to fund this, so the way they funded it was through an additional state income tax. Um, but individuals could opt out of that additional state income tax if they owned a qualified long-term care plan. So that's what drove up those dramatic sales in the state of Washington. And currently, there's 18 other states discussing similar legislation. The states that are closest to moving forward, they haven't, but are California, New York, Maryland, and Pennsylvania. And then there's these other states that are in early discussions for this. So all of this is raising the awareness for long-term care. COVID did as well when they saw the crisis in nursing homes around COVID. And it really raised the awareness for long-term care and planning ahead for long-term care. So let's talk about how the products have innovated and appealed. Um, this is all about asset preservation and flexibility. In other words, protecting your assets and determining who provides care to you and where you provide care. If you go to Medicaid, a lot of those choices are taken away from you. Your assets are being spent down and you have to go to Medicare approved facilities. They're no longer use it or lose it. They're built on either a life insurance or an annuity chassis, but they're really built from the ground up to address the leverage of long-term care, not a death benefit and not lifetime income. So if you don't use it for long-term care, that asset still passes on to your beneficiaries. And we have a lot of flexibility in funding. My parents are retired school teachers with a guaranteed increasing pension for life plus Social Security. They don't have a problem with a monthly premium they're going to pay for the rest of their life. Some other people that are retired on assets may want to move money from the left pocket to the right pocket. We even have options where the money stays completely liquid and not have an ongoing premium. Other individuals that are still working, if you're 55 years old, you may want to do a 10-pay premium so it's paid off by the time you're age 65. And we have all of these options. We also have options to fund plans with qualified funds as well. So, depending on how your client is invested, depending on how their retirement plan is structured, we have multiple different ways to fund these policies to meet their needs. What does it mean for you as an advisor? Well, of course, these are high value premiums that generate significant commissions as well. There's a tremendous cross selling opportunity. So, while not many people are talking about long term care because it's an underserved market, people are responsive to webinars or meetings when it comes to long term care. We have a great program we do called the Myths of Long Term Care. That's part of our toolkit that you can have access to. But if you're really going to put together a long-term care plan, you can't really do it until you understand their financial situation. In other words, people shouldn't be insuring 100% of the risk. They can insure self-fund some of it. So now you really need to get into their assets and their retirement plan to be able to recommend a long-term care plan that makes sense to them. And that opens up other opportunities, whether it's money management, annuity sales, life insurance, a plethora of other opportunities. And it can also lead to repeat and referral business. What I mean by that is there's not a lot of people that specialize in long-term care. And if you do right by your client, I've seen time and time again where a parent is diagnosed with Alzheimer's disease. I take care of one of their children and they refer me to all of their siblings, and we ended up writing all of their siblings. By the way, what's the best indicator that someone's interested in long-term care? When they have a parent that's going through it. Those are the people that buy it. And that's what really opened my eyes to create this long-term care planning toolkit, in that if everyone that is seeing long-term care in their own family is anxious to plan ahead for it and purchase products like this, then we have to do a better job of communicating the need for long-term care before they have to see it in their family. What is the benefits to your client? Well, first of all, there's tax advantages. We can reposition a taxable asset, such as a non-qualified annuity with gains in it, into a plan that, if they need it for long-term care, 100% of the funds come out income tax free, and we'll triple it for long-term care. We'll talk about that in a minute. They can pay for it if they have any self-employment income. They can pay for it with dollars that they can deduct about 75% of the premium out of their business. So pay for it with pre-tax dollars, and the benefits remain income tax free. So there are significant tax advantages. Of course, control and choice. When they have a long-term care plan like this that's providing that guaranteed income stream to pay for their long-term care expenses, now they have a lot more of control and choice of where they're receiving care. And of course, the legacy and retirement protection. Their children aren't seeing their inheritance being spent down, and the real risk for long-term care is when I need care and my healthy wife is still trying to maintain a household and a healthy lifestyle, and I'm spending down her retirement security. So it provides that protection. What are some of the challenges when it comes to long-term care that we really wanted to overcome with our long-term care planning toolkit? It's client misconceptions and denials. People don't think they'll need care. They think Medicare will pay. They think they'll qualify for Medicaid. And we have tools to overcome all of that. A lot of it's supported by videos. It's the terrible history of traditional long-term care plans, which were use it or lose it for long-term care. Yeah, you paid the premiums and you had the coverage, but if you pass away and never need care, nothing goes on to your beneficiaries. That's not the case anymore. And a significant history of rate increases on in-force business. These asset-based plans are or the premiums are guaranteed for life. They're not going to change. And for people that haven't been through care, there's an emotional disconnect. They don't understand the impact it's going to have on their family. And you'll see with some of the videos we've created in this toolkit how we help overcome that. So many people ask, what were the goals in creating this long-term care planning toolkit? One was to empower advisors. We have a complete training platform, you'll see, one-on-one coaching sessions with me personally, to get you up to speed on presenting asset-based long-term care um, um, uh, plans for your client. We also wanted to provide you the tools and the deliverables through the toolkit so you can help accelerate the client engagement and decision making. In other words, we wanted to simplify it for the client, give them be able to provide you tools that you can give them so they can understand the need for long-term care and how this product helps solve their problem. And we wanted to overcome those educational barriers and client misconceptions. You'll see we put together a lot of one-pagers for people that think Medicare or Medicaid pays, for people that want to self-fund care. And what we really wanted to do is differentiate the advisor in the retirement planning market. I do a whole course on the impact of long-term care on a retirement plan. And I show money managers and retirement advisors how to disrupt an existing advisor relationship and use their lack of planning of long-term care as a wedge in there. In other words, we take that retirement plan that other advisor developed, that might, when you run it through those Monte Carlo simulations, has a 97 or 98% success rate. But if we model in just the average long-term care stays, those success rates drop to 53% or 47% or 9% if they both need care. And that you'll see the chance of needing care is quite high. And when you illustrate that to a client and they didn't prepare it, and for a married couple over age 65, there's a 91% chance that one or both of them is going to need long-term care at some point, and they didn't model that cash flow drain in that existing retirement plan, that might just be the wedge you need to win that relationship. So let's talk now about our advisor's toolkit for long-term care. It takes the planning process that I've been personally doing for 30 years now and reduces it down to, in order for it to be successful, it has to be replicatable. So this complete planning process, we have the tools to keep you on track through it. The first meeting is the long-term care discovery meeting. One of the things you'll see is we'll do some in-field training via Zoom where you can position me as your long-term care planning specialist on your first two cases. And really, we're treating it as field training. And so I'm meeting with advisors and their clients virtually every day. A lot of times the advisor will come to me with the information. Here's Mr. and Mrs. Smith. They're 57 years old. They this, no non-smoker. They live in this city. Great. I don't need any of that for the first meeting. It's good to have, but I'm not coming with illustrations to the first meeting. This first meeting needs to be a discovery meeting. We need to understand what their understanding of long-term care is, why they're even talking to us about long-term care. And you'll see in the training modules and the training videos we have exactly how to conduct that first discovery meeting and which tools we're using. Then in the second meeting, we're putting together what we call our long-term care planning summary. And that's where we take actually 15 illustrations and reduce them down to a presentation that's going to show them, here's what it looks like to cover 100% of the projected expense at your age 80, 75%, and 50%. And I explained to them, I'm not a believer in insuring 100%. I believe everyone can afford to self-fund some of their own care without impacting, their spouse and their spouse's retirement security. From that, we can narrow it down to, do I like the full liquidity plan? Do I like the lifetime benefit? Am I comfortable with an 8-year benefit? How do I want to fund it? A single premium or a paid age 100 premium or something in between? So I show you how to go through these options and narrow down to a plan that makes sense for them. I know what plan I would buy, but that's not always the plan that makes the most sense to your client. And by going with these three options, no one can come in behind you and provide a better plan. And I'll show you what that long-term care planning summary looks like. The third meeting that we set up ahead of time, at the end of this meeting, I say, okay, Mr. and Mrs. Smith, what I'm going to do, we've narrowed it down to this particular plan, and you'd like the 10-pay premium at the 75% of the projected monthly expense. I'm going to run that illustration. I'm going to come back to you. You think about any questions that you have in the meantime. Review this long-term care planning summary. By the way, that summary that they're reviewing has a lot of embedded videos that helps establish the need. We're going to review this long-term care planning summary, um, answer any questions that you have, review the actual illustration at the next meeting. And none of this works. So, planning ahead for long-term care is all about creating leverage. And what creates leverage is your health. So once I answer all of your questions, if it makes sense, uh, and you want to see if you qualify, we can go through with the underwriting. It doesn't obligate you to anything. You don't have to pay anything, any premium or anything up front, but let's make sure it's even an option by using that soft close, if you will, to go through the underwriting during the plan refinement meeting and setting that expectation ahead of time. You're going to ferret out any objections that they may have. Once we go through that plan refinement meeting, answer all of their questions, get the application. Now, once the policy is issued, we come back in that fourth meeting for policy delivery and funding of it. So that's this process that I go through. And you always want both spouses there. What you'll find in long-term care, a lot of times women are driving these sales. Men think they have their own solution to it. It may be their Smith and Wesson. I can't tell you how many times I've heard that. Women are the ones that realize if something happens to my husband, I'm going to be the one taking care of him, and I'm going to be seeing my retirement planning being spent down. And they're the ones that really drive these sales. So one of the things we're going to send out to you after this, and we'll send you a video of this webinar, but we're going to send you out a login to our long-term care training platform. And there's many videos in here. 3 of them are required that we require you to do. And it's just going through the meetings and the planning process. Then there's other courses in there. For example, you have a small business owner or you have someone that owns a non-qualified annuity that are more specific on topic. Also about my explanation of some of the individual products that we're using. But once you complete those 3 required videos, then we're happy to brand all of this toolkit for you. If you work with a broker dealer, that's fine. Send it up to your compliance department and we'll make any changes that they need to it, or you can use it unbranded. However you want to use it, it's better. But I'm going to review some of the tools that we have now and how we use them. This is our long-term care planning guide. This is what I use to guide myself, even though I've been doing it for 30 years and I know it like the back of my hand. This is what I use to guide myself through that first discovery meeting. Again, this can be branded for you. This happens to be the Tampa St. Pete Clearwater edition. So we create the long-term care planning guide for whatever metropolitan statistical areas you're working with, because it's also a great lead generation tool. For you Medicare advisors, for you money managers, we have emails that you can send out to your existing client base introducing the 2025 Tampa Bay Long-Term Care Planning Guide that has 18 different integrated videos to help you understand long-term care. And you have them click on the email and download it so you can see who's downloading it. Anyone that's downloading it, that's them raising their hand saying, I've got questions about long-term care. I want you to call me and let's talk about this. So that's sort of that call to action for your clients. But this is, again, what we use in that first meeting. Now, the first question I always ask a client when it comes to long-term care is, what's your personal family experience when in regards to long-term care? Why are we even talking today? I can tell you right away, if a client is talking to me and they've had no experience with long-term care in their family, that's an uphill battle. They haven't lived it. People that have been through it with family members or are currently going through it with family members, they're the ones that are anxious to get a plan in place. So because of that, this first, and by the way, I'm going to dig a little bit. Oh, mom had Alzheimer's. Oh, how long did she receive care? Who provided care? What was the cost? What did that do to your family? Did all the siblings participate? In other words, you need to make it real again so they remember how tough it was when they were going through it, or if they're still going through it. For those people that haven't been through it, this first page sort of talks about the long-term care continuum. And throughout this long-term care planning guide, you're going to see QR codes. You can either email this to them as a PDF and they can simply click on those QR codes. Or if you print it, they can scan it with their phone. And everywhere there's a QR code, they can click on it and watch a brief video, anywhere from 1 to 3 minutes long. This particular video tells a story from mom's point of view of what it means when she starts taking care of dad, doesn't even know it's long-term care. Eventually, there's a discussion. She needs some help. They bring in home health care. Maybe then he moves out to assisted living or memory care, or then maybe more end-of-life nursing home. And now dad's passed on, and who's going to be there to take care of me when I need care? So for people that haven't been through a long-term care event in this family, we're trying to put together these emotional videos so that they understand it. So everywhere you see those QR codes like that, understand it's a video that you and your clients can watch, just 1 to 3 minutes long. Of course, the next thing is most men are going to say, well, I'm not going to need long-term care. Well, if you're over age 65, doesn't matter if you're male or female, there's a 70% chance as an individual you're going to need care, a 30% chance you won't. But look at for a married couple. And understand, for a married couple, it doesn't matter if I need care or if my wife needs care. It's going to have the same impact on our retirement security, the same impact on our children's inheritance. There's actually a 49% chance that both my wife and I will need care. There's a 42% chance that only one of us will need care and not the other. And there's only a 9% chance that neither of us will need care. So if I'm trying to create a wedge between a client and their current advisors to win a retirement planning relationship, and I show them that, well, your current advisor's financial plan didn't anticipate long-term care, and as a married couple, there's a 91% chance that one or both of you is going to need care. And if I just model the average long-term care claim in there, look what that does to your retirement security. Let's talk about how we can correct that. And of course, once again, there's these videos that help reinforce that. The next thing that people will, a lot of times, that I want to address proactively is they'll start talking to their children about it. I'm thinking about planning for long-term care, and most of them say, I don't want to become dependent on my children. That's the reason they're talking to us. But a lot of their children, especially their daughters, and especially if they're local, raise their hands and say, Mom, Dad, don't worry. Anything you need, I'm going to be there for you. And there's no doubt in my mind, I've seen it time and time again where those children are there for you. But you have to understand the beneficial role of a paid caregiver. If I'm in need long-term care and I'm in my time of need, I've got 3 children, 3 boys. I want my children, don't have grandchildren yet, but hopefully I will one day. I want my children and my grandchildren, yes, I want them there with me, but I want them there spending quality time with me. What I don't want is my children's last memory to be bathing me, dressing me, and toileting me. I want to hire a professional caregiver for that. And that's what this video gets across in a very compelling way. The next thing that we have to start to look at, and this is the only difference when we're looking at the metropolitan statistical areas when we create this material for you, is the cost of care in your area. So that first column is the cost of long-term care. That's the average of the informal care, home care, assisted living, and nursing home. So I'm assuming someone's going to move through that care continuum. Of course, in Tampa, St. Pete, we're looking at $80,230 a year today. But I'm not going to need care today, knock on wood. I'm going to need care 20 or 30 years from now. Now we're talking, $140,000 or $190,000 a year. And what people need to understand is long-term care is not an asset problem. Long-term care is a cash flow problem. And what if 20 years from now, when I'm retired, or 25 years from now, I need long-term care. My wife's trying to maintain a healthy lifestyle, and I have to increase our cash flow by $150,000 a year for an indeterminate amount of time because we don't know how long I'm going to live. What is that going to do to my wife's retirement security, my children's inheritance? And what are the costs and consequences associated with increasing that cash flow? In other words, if I'm having to pull money out of qualified plans, Not only do I have to pay taxes on it, but it will increase my provisional income, which means my Social Security taxes may go up. I may be subject to more IRMA tax or the Medicare premium surcharge tax. If my income goes up enough, I may now be subject to a net investment income tax. So there's a cascading effect of converting assets to cash flow. Now we start introducing, and this is the important part, the purpose that you plan ahead for long-term care. And the reason is to create leverage. We want $1 to do the work of $3, $5, or $10 for a long-term care. And this is a very important part of the presentation that you have to do, and it's stressed in the training videos. By the way, down below the video right there, you can schedule a time with me, book a time with me so we can get you started in a Zoom meeting. Start booking those meetings because those times do fill up quickly. So at this portion of the presentation, I say, Mr. and Mrs. Smith, if you needed care today, what's the first bucket of money you're going to? You might have cash assets, retirement assets, a brokerage account. What's the first bucket of money you're going to? And a lot of them will say, well, we've got $200,000 in emergency funds, in a CD, a money market. Okay, that's the first bucket of money you're going to. You can click that or scan that QR code with the cash equivalents, and it plays a brief video on what are the problems with using cash equivalents to fund long-term care. Now, the follow-up question I asked that is, all right, $200,000 in 20 years, that might get you through about a year and a couple of months of long-term care. When that money is gone, is that going to change Mrs. Smith's wife? If it's Mr. Smith, is that going to change her life if I'm the one that needs care? No, it's an emergency fund. We aren't relying on that for income. Okay. Now the cash flow need hasn't gone away. The cash assets are gone. What's the next asset you're moving to? Oh, it's a retirement account or a brokerage account. Now you can play that video again, and that's going to show the consequences of using that retirement account for care. And now I'm going to follow up that question. Now, is that retirement account being depleted? Is that going to change your spouse's lifestyle? And we're going to get to a point where it is changing their lifestyles. Now, don't get me wrong. I have people that can totally afford to self-fund long-term care, 20, 30, 40, $50 million net worth, that are purchasing these plans because they understand leverage and they understand the tax efficiency of it. This is for the average case that we're going to. So they've done two things for me. One, they've earmarked assets for long-term care in their mind. So if I can show them a way to use that asset more efficiently for long-term care, that can make a lot of sense. And I'm making it real, especially with the spouse there. I'm showing them, what happens when these assets are spent down for care. Now we're going to introduce the general idea of asset-based long-term care. And when I use the term asset-based long-term care, that means it's a hybrid policy either built on a life insurance chassis or an annuity chassis. But make no mistake, they're built from the ground up to address long-term care. They're not built to generate significant death benefit. They're not built to generate significant lifetime income. But they all kind of work the same. We're going to reposition a portion of your conservative assets. Remember, if they don't have assets to protect, they're not a prospect. They don't need long-term care. Medicaid or Medi-Cal is there for them. That is that social safety net. So we're going to reposition a portion of their conservative assets that they're comfortable that they won't need in retirement. And when I say reposition, that cannot be either done in a single premium. It can be qualified or non-qualified money, or it can be done on a monthly premium to their age 100. Sort of like they were dollar cost averaging into their 401k plan. So we're going to reposition a portion of your assets. If you need care, we're going to spend down your asset first, like your cash assets of $200,000 that you told me. Yes, we're going to spend down that $200,000, but here's the big difference. When that $200,000 is gone, they all have, they call it something different, extension of benefits, continuation of benefits, but there's an extended long-term care benefit where it keeps paying the claim. So you don't have to move on to that retirement account where it really starts impacting the spouse. And now what we can do is we can show them, you talked about cash holdings. That would be your first bucket of money. And you can play a video and it's going to talk in general the advantages of repositioning some cash assets into an asset-based long-term care, or repositioning retirement assets or a non-qualified annuity, or for individuals that are still working, employment income, in other words, just paying maybe an annual premium for the next 10 years while you're still working. Many people at age 72, when they have to start taking out RMDs, they don't want it. And we can reposition those RMDs into a plan where they're paying an annual premium to age 95, for example. Now, if you remember at the very beginning, what I told you, Mr. and Mrs. Smith, was long-term care planning is all about creating leverage, but it's not your money that's creating leverage. If that, that you could just use cash holdings and spend dollar for dollar for long-term care. We want to get each dollar to do the work of $3, $5, $10 or more. What's creating the leverage is your health. And we want to go through this health questionnaire in that initial discovery meeting. Why is it so important? Because there are plans out there that are guaranteed issue that we show to someone that if it's, they have significant health problems, can look very attractive. But if they put 100,000 in, we might turn it into 150,000 income tax free for long-term care, and it keeps growing from there. It's an annuity-based plan. But for people that are healthy, that same 100,000 might turn into 300,000 or 450,000 for long-term care. The problem is if I show someone that can't qualify for health-wise, that we can turn 100,000 into 450,000 or even an unlimited lifetime benefit. If I show them that plan first, and then because of their health, I have to go back to where we turn 100 into 150,000, it doesn't look very attractive. So you send this planning questionnaire back to our office here at MRW, and we're going to generate for that second meeting, that long-term care planning summary. All right. This is custom generated for your client, Mr. and Mrs. Smith. And it's not just the illustrations. You'll have the underlying illustrations as well, but I don't share that with them until I narrow down the product. I present from this long-term care planning summary. And here's the key about it. Remember, you have to have the spouse there. You're not going to take an application in this second meeting. All right. It's going to be the third meeting before you take an application. So they're going to be sitting with this long-term care planning summary, reviewing this, thinking of their questions. And if all you leave with them is an illustration, all you're showing them is what the cost is. And yeah, here's the potential benefits financially. You're not telling the full long-term care story. So what I want to do, I want to play just two of these videos for you real quick. Again, this is the long-term care planning summary. It's created specifically for them. The first one is spouses. Now imagine your clients thinking about this, remembering that women usually drive this conversation and are the ones that are pulling their husband into this conversation. Instead of just looking at what the cost of care is, now they have these videos reinforcing it. So I want to play this first video for you. And this is how care impacts a spouse. Oh, sorry, skipped over it. Okay, there it goes.
I never change like this. I love my husband dearly, but caring for him every day is harder than I ever expected. Every day brings new challenges. The physical work is exhausting. Some days it feels like there's no break, no time to rest. And then there's the money. All these medical bills, the cost of care, the medications. I worry about what's going to happen to our savings. Will we have enough? It's not just the physical and financial strain. It's emotional too. Some nights, I feel like I'm losing a piece of myself, that I'm disappearing into this role of caregiver. I realized I couldn't do this alone. Planning ahead for long-term care became the lifeline I didn't know I needed. The fact we spoke with someone that helped us plan ahead for care helps me make sense of it all today and gives me hope. We needed a plan, something that would protect us financially, so I could focus on caring for him without worrying about losing everything we've worked for. Since we have a plan in place, I can care for my husband without that constant fear hanging over me. I can be present for him and still take care of myself. Planning for long-term care isn't just about the future. It's about finding peace in the present. Don't wait. Start planning now. It's not easy, but with the right plan, you can get through it, stronger, together.
So you can see how these videos are going to help reinforce the conversation, especially when you're not there. I picture, the husband, complaining a little bit about the cost, and while the wife is watching these videos, and it's really empowering her to have that conversation with the husband on why they should move forward with this. I want to show you one other video. Again, it's just a little over a minute long, and this is on retirement income.
When we envisioned retirement, we pictured it filled with travel, family gatherings, and enjoying the home we worked so hard to build. But life changed. My husband's memory started slipping, and with time, his need for care has only deepened. The reality of providing that care, the constant expenses, was something I just wasn't prepared for. I never thought I'd be here, looking at our savings with a sense of dread, wondering how long it will last. The care he needs is constant and complex, and while I would give him everything, I'm terrified of what it might cost us both in the long run. It's the hardest part of this journey, watching what we saved for decades start to slip away, month by month, with every new bill. The financial burden of his care keeps me up at night wondering, will I have enough to take care of him and still support myself? Will I be forced to sacrifice my own well-being just to make it through? If only we had known. There are ways to prepare for this, to structure our funds in a way that would have supported his care without risking everything we built. Options like asset-based solutions that could help cover long-term care costs without draining what I need to live on. I'm telling this story because I don't want others to go through this same fear, to face this same uncertainty. By planning ahead, by exploring solutions that protect against the unexpected, you can secure both care for your loved one and the peace of mind for yourself. Don't wait to plan for the unknown. Protect your family, your finances, and your future.
And I'm telling you, people are watching these videos. I see the numbers as the videos are watched, and they're effective because they're helping to tell the whole story, not just the financial side of it. Every one of these videos, they're just 1 to 3 minutes long, life expectancy, cognitive. I'm not going to play all of these for you. Robbie's going to email out to you where you can download the long-term care planning toolkit samples. One of the things we do focus on, again, I'm not going to play the video though, is that long-term care is an cash flow problem, not an asset problem. Now, this is where we get into the actual planning summary and how we're putting together solutions for them. And by the way, when we send you this long-term care planning summary for your client, we send you 3 versions of it. One where we're covering 100% of the projected cost at their joint age of 80. By the way, this is for a married couple that's 60 years old. The current cost of care in the Sarasota Bradenton area for that blended cost of care, which is the average of informal home health care, assisted living, nursing home, is $7,550. At their joint age of 80, that's going to be $13,636. And that red number there, that's the monthly benefit we're solving for. So when I say you're getting 3 versions of this, one of it's going to have a monthly benefit of $13,636. Another one's going to have it at 75% of that and 50% of it. And I explained to them I'm not a big believer of insuring 100% of it. We also have down below at the bottom if they say, well, we may retire in North Carolina, you can click there to see what the cost of care would be in North Carolina or the state of New York or any other city or state that they may be interested in. Now we start to move forward and illustrate that long-term care is a cash flow problem. In other words, if you had to generate $13,636 a month to pay your long-term care expenses and you're withdrawing it from your IRA, your 401k, your qualified plans, just taking into account federal taxes, you'd have to liquidate $19,480, pay $5,800 in income taxes to net out that $13,636. If you're liquidating capitally appreciated assets, that, by the way, capital gains tax is completely avoided because of a step up in basis if you hold it till death. But if you liquidate it for long-term care, you're going to have to pay $2,400 in taxes, so you have to liquidate $16,000. You said you were going to start off with cash assets, that CD, that money market that you said you had $200,000 in. Well, you'd have to liquidate $13,636. You'd have to pull that dollar for dollar out. What we want to do is try and find a way to do that with up to a 75% discount or more. Now, the first option we always show, and this is where we're getting into some of the product solutions, is a fully liquid option. I want them to understand the concept of we're not spending this money, we're moving it from the left pocket to the right pocket. So, just to give you an example, you told me you had about $200,000 in cash assets as an emergency fund. If we wanted to cover 100% of that cost, that $13,636 a month, the single premium for that would be $220,697. This is One America's asset care plan with the return of premium option. Now, understand, Mr. and Mrs. Smith, at any time, you could decide, you know what, this plan's not for me and get your entire $220,000 back. Okay. So you're not spending that money. Yes, it's costing you something. There's an opportunity cost. It's costing you what you would have earned in interest in the bank with that $200,000. Right. If you don't need it for long-term care and you pass away, this is a joint policy that's covering them both. So it's a second to die income tax-free death benefit of $327,000. So if we take that $220,000, move it from the left pocket to the right pocket, you don't need any long-term care, you pass away, $327,000 goes on income tax-free to your kids. All right. Like I said, it's not tremendous death benefit leverage. It's not designed for that. But here's what it does for long-term care. And this one is based on 100% of that projected cost. So that's $13,636 a month in benefit. And that is per person. So if husband and wife went on claim at the same time, remember they're both covered under the same policy, it would pay north of $27,000 a month. But it is a combined benefit account value of $981,792. So the way I like to explain it is you could each write a check for your care up to $13,636 a month, but think of it as you're drawing against the same joint checking account. If only one of you is on claim, that's going to last for 72 months or 6 years. So think about this. If we wanted to generate that $981,000 of spendable money on long-term care and we were withdrawing the money from our tax qualified plans, we'd actually have to withdraw $1.4 million, pay $420,000 in taxes to get $981,000. If it was non-qualified assets that were subject to capital gains tax, we'd have to liquidate 1.1 million. If it was just withdrawals out of our savings account or money market, those cash equivalents, it's dollar for dollar, $981,000. We're accomplishing this for $220,000. So that's where we're talking about that 75% discount. Now, personally, I'm not a big believer in the full return of premium. I believe clients should feel comfortable setting aside this money, saying we don't need it for our retirement, but for long-term care. And if we don't need it for long-term care, we want it to pass on to our beneficiaries. So we can create more leverage. That means I don't sell the return of premium because I'm a big believer that something is better than nothing. And many people like this return of premium feature. There's been two occasions when I thought this was the right solution for the client. One was there's a husband and wife, both from New Zealand, both New Zealand residents. They're professors here at University of South Florida. They weren't sure if they were going to retire here in the United States, where they're responsible for their own care, long-term care, or if they were going to go back to New Zealand, where there's state-paid care. And they were going to make that decision in the next 3 to 4 years. So it made sense to have the full liquidity, go ahead, lock in their insurability. If they stay here, they've got their coverage. If they go back to New Zealand, they can cash in and get all their money back. The other situation was second marriages. A lot of times you have second marriages and people have taken steps to make sure the assets they're bringing into their marriage remain theirs and goes on to their children from their first marriage. But long-term care doesn't take that into account. Medicaid spend down doesn't take that into account. If I marry a new spouse and I bring assets into the marriage, all assets are looked at jointly and need to be spent down to Medicaid. The last thing sometimes you want is your kids seeing their inheritance being spent down on the new spouse's care. So this gentleman bought a policy for his his new spouse. He was the owner. He was the beneficiary of the policy, but he put return of premium in it. And he was very upfront with me. He said, I want to make sure we're protected. I want to make sure my kids' inheritance are protected. but I'm not sure the marriage is going to last, and I want to be able to cash it in for a full return of premium if the marriage doesn't last. Um, but if they don't want that full return of premium, then I move on to what we call maximum leverage. So this is Nationwide's Care Matters Together product. Now, this can be paid with different options. The full liquidity has to be a single premium. This can be paid with a single pay premium. And look, it's about $10,000 more, but you'll see we're getting about a $500,000 more benefit for that extra $10,000. That's why we call it maximum leverage. But they could also pay this in a 5 pay premium, a 10 pay, a 20 pay, or a pay to age 100. Now, if we were showing the 50% option, because I told you I'm not a believer in insuring 100% of it, all these numbers would be cut in half. Okay. Um, what are they getting for that? In this case, we are selling a 3% compound annual inflation rider. So the monthly benefit's going to start off at $7,550. And at their joint equal age of 80, it's going to be $13,636. So that's what we're equalizing is what's the monthly benefit at their age 80 when they're more likely to need care. That means the total pool of money is growing from 800,000 to 1.4 million. If they don't need it for long-term care, yes, they put in 233,000. If they do it as a single pay, and 271,000 is going tax-free back to their beneficiaries as a second to die death benefit. But if they do need it for long-term care, we're generating that $1.4 million of income tax-free cash flow. And you can see out of tax qualified plans, they'd need to liquidate $2 million. $1.7 million out of non-qualified plans, $1.4 million out of cash assets. We're accomplishing this for $233,000 in a single premium. And again, they don't have to do a single premium. They can, for lack of a better term, finance it over 5 years, 10 years, 20 years, or a pay to age 100. Now, some people have a problem, especially if they've had a cognitive impairment or Alzheimer's in their family. And they say, well, what if my husband uses all 8 years of benefits and leaves the wife with no benefits for long-term care? Well, first of all, then this was the best purchase they ever made because they got $1.5 million out of it rather than going through assets. But the real risk of long-term care is when you have a healthy spouse that wants to maintain retirement security, maintain the household and a healthy retirement lifestyle, and a drag of $15,000, $20,000 a month of additional expenses for long-term care. Once I'm gone, I've passed away. If my wife needs care, well, she can liquidate the house, move into independent care or assisted living or memory care, and redirect a lot more of our retirement cash flow to her care because we don't have a healthy spouse we're trying to maintain care for. But because of that question and that concern, we always show an unlimited lifetime benefit as well. And this is One America's asset care product. It's actually the same product as the full liquidity product. It's just got a different product design with the riders. We have the different premium options everywhere from a single pay out to a pay to age 95 premium. It does provide the $13,636 a month benefit, but now it is an unlimited lifetime benefit period. So it is a benefit that can never be exhausted. $327,000 second to die death benefit. And I can't do the same analysis of how much you'd have to liquidate out of your qualified plan or capitally appreciated assets because it's an unlimited lifetime benefit. There is no cap. So instead, we show what the claims, some of the longest claims that have been paid. Now what I do is I back up and I show the options to the clients. I go, we've looked at three basic options. One where we maintain full liquidity. We're giving up some leverage. We aren't getting the maximum leverage there. Another one where we're showing the maximum leverage. And another one that's really unlimited leverage. It's the unlimited lifetime benefit plan. What's speaking to you? And I narrow them down to which plan they think makes the most sense for them. I'll tell you, there are people that just default to the full liquidity option. That's usually when one spouse is wanting to do it and not the other. It gives them an out. They aren't making a commitment. The maximum leverage makes sense to a lot of people if they have not been through a cognitive impairment with a family member. It's Alzheimer's disease, the senilities that lead to the real long claims. And those individuals might be willing to pay a little bit more for that unlimited lifetime benefit. Again, there's not a right or wrong answer here. Then I'm going to see now, when it comes to funding, what's the most attractive way you want to fund? Do you want to move money from your left pocket to the right pocket and just have a single pay and be done with it? or would you rather want a monthly premium to your age 100 or somewhere in between? And we'll narrow that down and we'll usually, get to one or two choices. And then it becomes how much of the projected expense do you want to cover? Is it 75%? Is it 50%? Sometimes they say, well, can you show me what a $100,000 single premium would do? Now, let me tell you, I have clients on claim today getting $1,500, $2,000 a month through policies I sold them 25, 30 years ago where they didn't want to buy the inflation protection. And yes, hindsight's always 2020. They wish they had purchased more, but not one of them's upset they're getting the money they're getting. So I don't believe there's a right or wrong answer. It's what feels right to your client. In Florida, I like to say the juice has to be worth a squeeze. It's finding the balance of the premium dollars and the benefits. I get a lot of advisors that say, well, they're up in New York and this state of New York or New York City care is very expensive. And they say, well, what good is a $5,000 a month benefit? Well, if your client's on claim getting $5,000 a month, you got correct. It's not paying 100%, but it's sure helping out. Now we can come back to the client in that third meeting with the one or two illustrations that they're really interested in. So that's how we're using this long-term care planning summary in the meeting. On top of that, here's some additional pieces in the toolkit that we've developed. And these are sort of, we call them one-page flyers or one-pagers that just when the client has these questions, they're meant to help overcome them. And again, with all of them, you see that they've got the videos. This is something we're going to brand for you. And this one's great for who pays for long-term care. It shows what Medicaid spend down is and how much of their assets they actually have to spend. Maybe they've had a knee replacement and Medicare paid for that nursing home stay after the knee replacement. Well, it shows, yeah, Medicare covers the first 20 days of daily skilled nursing care if there was 3 days prior hospitalization and the care is rehabilitative in nature. In other words, it shows what all the limitations are and that Medicare never pays beyond day 100. And once again, we have those videos to help reinforce that. Another one pager we have that's greater for those individuals that want to self-fund care. And it's the consequences of self-funding care. One is that, the 18 other states that are talking about that additional state income tax if you don't own long-term care. Another is tax exposure risk. You may be paying capital gains tax and liquidating properties or liquidating assets that capital gains tax would be completely avoided if you pass that on to the next generation. Or if you're pulling money out of qualified plans, how that can really be compounded because now your provisional income is up. Now you may be paying more taxes on your Social Security, a higher IRMA tax or Medicare premium surcharge tax, and maybe even a net investment income tax. If you are liquidating assets, I just touched on it briefly, but the loss of step up in basis, if you're liquidating assets that are capitally appreciated. I can't tell you down here in Florida how many times I see a home that was in fact, one of my neighbors, he went into a nursing home. He spent about 3 or 4 years in a nursing home and they just held that home. They didn't sell it. Well, it's because it's the home that the children was raised in. If they sold it while that child was alive or while that parent was alive, there'd be capital gains tax associated with it, where if they hold it until they pass away, they can sell it and completely avoid the capital gains tax. Sequence of return risk. I'm sure many people on this call went through 2008 when, portfolios dropped by 40%. You maybe even had clients that had to postpone retirement for a couple of years because you told the same story I did. You aren't locking in the losses until you liquidate those assets. We usually recover, as we did after 2008. You usually recover after a downfall like that. But guess what? You can't postpone. You can't postpone long-term care. Now you're liquidating these assets in the down market and you never hold them and you don't hold them anymore for the market to recover. Chances to leverage business income. I get many people, especially the men, that say, all right, let's do something, but let's just maximize the tax deduction. Just design the plan so I can maximize the tax deduction today and I'll self-insure the rest because it's not going to get you, 100% coverage. The wife's happy. We've got some long-term care coverage. The husband's happy because we're getting that tax deduction. And then also, if you have a client that's got an irrevocable life insurance trust or some assets in an estate outside of their trust, think about this. We can do a cash indemnity plan where They pay for their, if they've got an estate tax problem, obviously they have the assets to self-fund care, but now they can pay for their expenses out of their estate that's subject to estate taxes. And that life insurance trust or that irrevocable trust that's outside of estate taxes can be reimbursed with that tax-free cash indemnity benefit. So some tremendous planning that can be done there. One other great tool is the Pension Protection Act. It allows clients to access their non qualified annuities income tax free for long term care, but it has to be compliant with the Pension Protection Act. So it is a specific type of annuity. So think about your clients that are pissed off that they have to take out required minimum distribution. Maybe they put $100,000 in a non qualified annuity, 10 years ago, it's grown to $200,000. Well, the first $100,000 they take out is taxable as ordinary income to them, and they're not going to touch it because they don't want the taxes. They don't need it to fund their retirement. So it's become a legacy tool. They're going to pass that annuity along with the deferred tax liability onto their kids. No step up in basis on annuities. The first 100,000 their kids take out is going to be taxable to them as ordinary income. Well, what if we could 1035 that annuity into an annuity that's compliant with the Pension Protection Act? And I don't care how the existing annuity is titled, if it's in the husband's name, the wife's name, jointly, it doesn't matter. We can cover them both for long-term care. Here's what the Pension Protection Act does for non-qualified annuities. Easiest way to remember it is it's there to benefit your clients, not their children. If it's a Pension Protection Act compliant annuity, the money that comes out as a long-term care benefit, the first money that comes out is a tax-free return of cost basis. So that first 100,000 that comes out is income tax-free. Now, when they get into the gains, that also comes out income tax-free for long-term care benefits. Once they exhaust their $200,000, in this case, this particular annuity triples it for long-term care. So there's an additional $400,000. If you remember that pie chart earlier, that's that extended long-term care benefit that comes out income tax-free. By the way, this particular annuity on amounts of $200,000 or more, it's currently crediting 6% interest. Under that, it's crediting 5.5% interest. And whatever that annuity value grows to over time, when they start the claim, it triples the value for long-term care, except for California. It works a little different in California. But other than California, it works that way. So this isn't as much about what's the cost of care in Sarasota, Florida. It's, I've got this $200,000 annuity that's basically become a legacy tool. How can I leverage it for long-term care and potentially access it income tax-free? It's the only way for you or your beneficiaries to avoid income taxes on that non-qualified annuity. We also have a one-pager, and again, can be branded for you for your small business owners and how they can deduct it. Married couple in their 60s, they can deduct north of $9,000 a year in premium, and all of the benefits stay income tax-free. It's an above-the-line tax deduction for self-employed health insurance deduction. It is deductible off someone's personal return, but only to the extent it exceeds 7.5% of their adjusted gross income. So most individuals aren't going to get an individual deduction. However, if they have a healthcare savings account, these same caps apply. We can pay for the premiums up to the caps that are age-based out of their healthcare savings account with pre-tax dollars. And the last one pager I want to show you is one that is for C corporations. I understand there aren't a lot of C corporations out there, but when you find them, golden opportunity. Had a situation, 85-year-old gentleman owned a C corporation in Sarasota, Florida, owns a lot of commercial real estate. All three of his children work in it. His wife is currently at home with round-the-clock home health care. He realizes how expensive it is. We were able to put $200,000 in each policy for his three children that worked for the corporation. None of them were married. We could have done it for their spouses as well. So it was a total of $600,000. The corporation got a $500,000 tax deduction for that. And oh, by the way, that money, $600,000, is completely liquid in 5 years. And now the kids have a very robust long-term care benefit, and all of the benefits paid for it out of it are income tax-free. So tremendous opportunities when you run into a C corporation. I mentioned briefly earlier our assisted long-term care sales process. That is something that we offer on your first 2 sales, where you can position me as your back office long-term care planning specialist. Make Make no mistake about it. I want to get you up to speed. We're trying to provide you through this training portal, these videos, through Zoom meetings with me, with one-on-one coaching sessions, how to get you up to speed on your own. But I also think the best way to do that is see it. So for your first two sales, you can book a meeting with me the same way you can book a meeting right below the video for an initial Zoom meeting to introduce ourselves to each other. But you can book a Zoom meeting with me and your client, and I'll be your back office long-term care planning specialist, and I can carry the heavy load of the conversation all the way from the initial discovery meeting out to policy delivery and policy funding. Now, we're not set up to do that because all your contracts are direct with the carriers, full commissions to you. We're just working on our overrides. We're not set up to do that on an ongoing basis. It's an investment we're making in you in field training. So we do have some advisors, money managers, property casualty agents that have a license, but they don't really want to learn it, but they want to understand their clients are taken care of. If you want to work that way and you decide on a case-by-case basis, there's a split then after your first two sales. If all you're doing is referring over a name and I'm following up with you and you aren't on those meetings, then it's going to be a 50-50 split because they're going to be relying on us for the service work as well. And I know we won't be as successful if you weren't there on the meeting. If you're there every meeting with us, it would be a 70% to you, 30% to MRW split. And you decide on a case-by-case basis. Sometimes I get people that want to do it on, a family member or someone, so they're not making that presentation. That's fine. You decide on a case-by-case basis. We really want, because it saves us bandwidth for you to be self-sufficient on it and want to do everything we can to get you self-sufficient. If, by the way, you've gone through a meeting and let's say it's with the C corporation and now you've got the accountant, the CFO on the line and they're talking about getting into weeds on the tax deduction. I'm always happy to jump on a Zoom meeting one-off like that. No split in compensation. It's just I'm not going to be able to be there every step of the way of every meeting carrying the load. So I'm always willing to be the sort of that prophet from afar when it comes to long-term care. So that's what we've put together in this long-term care planning toolkit. I hope you take the time to schedule a Zoom meeting with me so we can spend 30 minutes together, really understand your practice and how we can work this into your practice. Because we all get paid the same way. I'm only successful if you are successful. And it's our goal to make you successful and an absolute expert in long-term care or become a resource for you and your clients when it comes to long-term care. Once again, my name is Tom Vassallo with MRW Financial. I know it's like drinking from a fire hose here, but I promise you with the training program we've put together, with the toolkit we've put together and the video supports we put together, we can get you up to speed on this very quickly. Thank you, everyone, and have a great day.